Happy Halloween Eve to everyone, and welcome back to Lamb's Cryptoverse. Today, I don't want to talk about Halloween's Eve. I want to talk about the eve of all this economic data coming out. So we're going to go to this really important screen here. It's on U.S. economic data, the calendar basically from Market Watch. And what I want to highlight is all this important data coming out. Well, today we had the Chicago PMI, and it was below 2 points below what was expected. But what I really want to focus on is on this. The ISM Manufacturing Index is coming out tomorrow, and they're expecting 50%. If that goes down, that's going to be very significant. That's a really important data point that basically precedes, it's basically the canary in the coal mine that precedes the decline or incline of U.S. economic data, GDP. And another one that's really important is FOMC announcement. That's the Federal Open Market Committee. They're going to be raising rates, and unless it's not obvious to you by now, unless you've been living under a rock, hopefully you're expecting a 75 basis point increase in the Fed funds rate, because that's what we're going to get. And then, of course, there's a press conference at 2:30. And very importantly, something I usually, or typically over the last 10, 20 years, I did not focus on was the ISM Services Index. But it's important for two reasons. Number one, 2/3 of the economy is a service economy. But more importantly than that, it's hard to believe, but yes, there's something more important than services being 2/3 of the economy. It's that the inflation that we have now is sticky because it's related to the services economy. It's related to workers. There's a lot of workers, especially service workers, that have high wage growth. So there's sticky wages. So if the ISM index comes down, so they expected 55.5. If it comes down below that to like low 50s, 52, 53, then this is going to be very good for the stock market and treasuries. And of course, Friday, we've got the non-farm payrolls and unemployment rate. And as you know, the economy has been much stronger than everyone's expecting. And employment has been at the crux of that. Employment and wages have been very strong. So let's see how that comes out. Now, I also want to talk to you about something no one's talking to you about, and that's the disparity between the bond market, meaning sovereign treasuries, and the stock market. The stock market, as you know, has been strong lately. I think the market's up like 10 to 12% off its lows. So it's bouncing off sharply. It depends on what index you're looking at. But basically, value stocks are up more than growth stocks. But they're all up a lot since the lows. But here's the thing. The Treasury market is not reflecting that. Treasury bonds, especially U.S. Treasuries, but also the UK, have been weak. So rates have been rising sharply, including today. On Halloween Eve, rates have been increasing sharply, including the 30-year rate and the 10-year rate. And there's a saying that the bond market speaks the truth. And I think that's somewhat true. The thing is, the bond market, meaning treasuries, is reflecting real or lagged, whatever, economic data. So until we see economic data or survey data, so hard data or soft data, weaken, we're not going to see the bond market, the treasury market rally. So I think that's the key point to keep in mind for the next few days coming up. These are crucial days coming up. This could be part two, where I was talking about with the stock market, whether or not it's going to reflect the compression of earnings or it's going to reflect lower interest rates. So keep that in mind, folks, and good luck. Bye.